Welcome to Maxwell's Entrepreneurial Moment. Having run an engineering company now for over 30 years, I want to share a few things that I've learned along the way. I'm Brent Maxwell, the president of PSE. In this clip, I'd like to discuss how to read a balance sheet. The balance sheet is simply an accumulation of balances of accounts through a given time period, usually the end of the month, a quarter, or a year. A balance sheet is comprised usually of three things, but I want to include four: the assets, the liabilities, and the owner's equity. And then the fourth one I want to include is the notes. While all are important, the notes are often discounted, excluded, or not even read. The hidden details and potential gotchas are usually hiding in the notes. Often the notes are overlooked. Off-balance sheet items are in the notes, and they can materially affect a company. The notes explain things that are often unrecognized and potentially they're good or bad for the company. So always look for and read the notes. I like to read them first. The assets less the liabilities equals the owner's equity, or how much you made. The equation should always balance, hence the balance sheet, right? Assets and liabilities are broken down usually into short-term and long-term. So you have short-term liabilities and short-term assets, long-term liabilities, long-term assets. Usually 1 year is the demarcation for those short-term and long-term intervals. You should ensure that all accruals have been included in the balance sheet and not just some of them. Accruals like accounts receivable, cash, payables, depreciation, PTO, or long-term notes are all accumulated on the balance sheet as you finalize a month, a quarter, or a year. There are key indicators that you want to pay attention to on a balance sheet. The first is the quick ratio. The quick ratio is comprised of the current assets divided by the current liabilities, excluding inventory. This gives you a relative strength or ability of the company to pay its current obligations. The higher, the better. You should know what is normal in your business and industry. The next ratio you should pay attention to is the current ratio. The current ratio is the same as the quick ratio, but the current ratio includes inventory. Now, if your inventory moves quickly, current ratio is probably a better gauge. But if inventory sometimes is sticky or hard to move, the quick ratio is probably your better gauge of where you're at and the strength of a company. Another good balance sheet item to keep track of is working capital. It could be called the short-term income, because what this is essentially the difference between current assets and current liabilities. You subtract the difference, you know what you got, and that's kind of your current net income or your current capital that is available to handle ongoing operations. And finally, your solvency ratio is another one that could be very helpful. This lets you know how much money you have available to pay down your liabilities or debt. It's found by dividing your net income plus depreciation by your liabilities. Usually above 20% is good, but again, every industry has its own standard. I hope this was helpful. Balance sheet is rather simple. It's just balancing the accounts over time. So read the notes first, or at least read them. Don't skip the notes. They're really critical. Don't let the gotchas get by you. And then have a great time. Find out how your company's doing, look to improve your ratios, and then enjoy the journey. Thanks for listening.